Someone said they found it funny when we talked about profiting from the misfortune of others. Well, generating alpha is no laughing matter, and there's one superior way to invest in the misfortune of others: defense stocks. Love them or hate them, today we're going to talk about everything defense stocks. So let's start at the top. We need a universe of stocks, and since this is a mature space, we can look for an industry classification. Now, we always like to start by looking at ETFs, and here's a list pulled from Vetify. I think 4 of these are of interest. At the bottom there, you see ARK's Space Exploration and Innovation ETF. We've covered that before. You have the Direction Daily Aerospace and Defense Bull 3x share. So this is one of those leveraged ETFs, high fees. We would avoid those like the plague. And then at the end there, you have the Spider Kensho Future Security ETF. And we've covered Kensho's indexing technology before, but this ETF is just far too small for us to consider. So we have 4 remaining of interest. And if you look at the labeling there, 3 of the 4 contain the word aerospace. So that seems to be part and parcel of this theme. And you know the old joke, they say, what's the quickest way to become a millionaire? Well, it's to invest $1 billion in an airline. So when it comes to the sort of aerospace we're talking about here, these would be companies that manufacture airplanes. And when we look at the GICS classification, so that's Global Industry Classification Standard, and it's a way to segment companies by what they do. Here you can see the breakdown under industrials, so that's a sector we're all familiar with, and you have capital goods, then you have aerospace and defense. So companies that fall within that classification would be of interest, and it's likely that these ETFs are looking at these industry classifications when they pick their constituents. And for example, when we look at a large industrial sector fund here, we see that aerospace and defense is the largest subsector, and that's accounting for about 23% of the total weighting, followed by machinery and ground transportation. Now, when we look at these 4 ETFs, this is rather interesting. They're all using a different index, so it's likely that the list of constituents for each will be rather different. Now, before we get into that, I pulled up this ranking list produced by Bloomberg that shows the top federal contractors for fiscal 2022, and the usual suspects are along the top there. 1/3 of contracting money went to 15 vendors in 2021 and 2022, so rather concentrated. Major defense procurement markets rely on a few large vendors, as you can see here. What's interesting also to note here is that Boeing's 2022 contract awards plunged 32% on aircraft declines. Boeing's been running into some problems lately, but these names should be seen throughout these 4 ETFs. And what we've done here is we've taken the top 10 constituents for each, and then we've looked at the names found across all 4. The idea here is this, that we want to find the names that all 4 of these index providers agree upon so that we can get ourselves a pure play list, a basket, if you will, of defense stocks. So 4 names are found in all 4 ETFs, and 4 names are found in 3 of the ETFs. So these 8 names are of interest. The other 2 that you see, they're Axon. So we're going to do a presentation on them actually as a result of our premium subscribers asking for that. The other name is an aerospace firm that I'm not familiar with. Now, when we compare those 8 names to the rankings list that I showed you before, well, look, they're largely represented here. So the 4 that are found in all 4 ETFs, unsurprisingly, are on this list, denoted there in yellow arrows. And then when it comes to names that were found in 3 of the 4 ETFs, you have General Dynamics and Boeing. Those are also represented. And General Electric is on this list. It's 200 firms. It's in position 32, and Howmet isn't actually on the list, which is rather interesting. So what we then have are a list of 8 defense stocks, and this is one possible basket that you could consider if you wanted to assemble such a basket. It's very U.S. focused, and I think when you look at who spends the most on defense globally, that makes a lot of sense. You see here the United States at the top, followed by China, then Russia. So this is 2023 military expenditures. Now, if you're dealing with the U.S. Department of Defense, they're going to have a say about who else you sell your products and services to. That's not very surprising. the Department of Defense as a customer is really the BSD in the room, and they call all the shots. So that's a risk that you need to be aware of. Fortunately or unfortunately, U.S. spending on defense hasn't decreased over time. It's only steadily increased. And of course, these firms also export some of their freedom to other countries. Here you can see the leading exporters of major weapons during a particular time frame there. And interestingly enough, the top 10 importers of U.S. arms, they're at the top, Saudi Arabia, but the Gulf Cooperation Council, the GCC, buys 35% of U.S. exported weapons. Rather interesting. What you can do for each of these names is then go into their SEC filings and actually look to see what sort of government dependencies they have. So here's an example. This is Raytheon, obviously, and you can see the breakdown there. So you can see what percentage of the revenues are commercial versus the U.S. government. One problem you'll run into is that firms that sell to the U.S. government are fairly opaque, so they'll usually flaunt some contract wins, but then they won't tell you very much about contract losses. So that's one issue that investors will no doubt run into. Now, when we look at the 4 ETFs, getting back to that list of 4 ETFs, Morningstar found, without a doubt, that low fees are the best predictor of performance. It's not really a surprise over long periods of time. So we want to stick with names that have low fees. You see the one on the bottom there, the Global X ETF. That has quite low AUM compared, that's assets under management, compared to the other 3, so under $600 million. That means that they can't help but charge higher fees. The more assets that you're managing, the less fees that you can charge. You'll just make that up on volume, right? So I think the 2 names that would be of interest if we were going to look at overweighting defense stocks would be ITA here and XAR. So they're charging, 40 and 35 basis points respectively. Well, is that good or bad? Well, you could invest in Vanguard's Industrials ETF. I think this gives you 19% exposure to aerospace and defense and pay just 10 basis points. So if you're really, really bullish on defense and you want to overweight, then those are 2 ways that you can do that. When you look at the Dow Jones U.S. Aerospace and Defense Total Return Index, so that's one of the 4 that are used by these ETFs, you see over the past decade it's actually performed almost on par there with the S&P 500. I know some of you will be wondering about performance, but what I found rather interesting is that war is a profitable business. So we recently did a video on the top performing stocks ever. It's a paper that was put out. It's a rather interesting piece. You ought to check it out. But look, 3 of the names here in the top 10, 2 are aerospace and defense, General Dynamics and Boeing, though Boeing, as I said, in a bit of trouble. And then you have Northrop Grumman there in the list of, I think these are the top 25 here. So war is profitable. If you want to invest in defense stocks, there's really 3 options here. You can buy an ETF. As we looked at today, I think XAR or ITA seem the most compelling. Of course, their expense ratios can change, but the fact that they have volume in their assets under management means that they're more able to lower fees rather than increase them. You can create your own basket, so you could buy the Hateful Eight, or you could cherry pick a winner. And if we were to do that, we'd probably try and use an objective method. For example, we'd stick with dividend champions or upcoming champions. And I pulled up our list of companies that have not only paid but increased a dividend for 20 years or more. So champions are traditionally defined as 25. But in our new Quantigens Q-Score calculator we'll be debuting soon for paying annual subscribers, we've also added the up-and-coming dividend champions. And look here, this is very interesting. You have RTX and General Dynamics that are already champions, and RTX actually has a pretty good Q-score. You see that column on the right? That's a score we calculate to rank dividend growth stocks, and it uses the various variables you see here, such as international revenue, size, 5-year growth rate, 10-year growth rate, yield, and payout ratio. But RTX has a pretty high score, and Lockheed does as well. Looks like they're going to be a champion in 4 years. Then you see also L. Harris, and a champion in 2 years, and Northrop in 5. So quite a few defense plays will soon be dividend champions. You have 2 that already are. And I wanted to leave you with this quote. I love it. It says, The true soldier fights not because he hates what is in front of him, but because he loves what is behind him. I think that's beautiful. And I also think that you'll love this next video. It's a closer look at Raytheon. Please give that a watch. Make sure to subscribe to our channel. Thanks so much for taking the time to watch this today.